Hello, everyone, and welcome back to the Direct Insurance Podcast, otherwise known as DIP, a podcast for independent insurance agents brought to you by Insurance Advisors Direct, a full-service FMO. I'm your host. My name is Kelsey. I'm the digital marketing assistant as well as social media strategist here at IAD. And today I am joined by my very special guest, Chris Schiefer of TruChoice Financial. Hi, Chris. Thank you so much for joining me today.
Well, thanks for having me. I really appreciate it. Good morning to everybody, or good afternoon, whatever time of day it is you're listening to this.
Awesome. Thank you so much, Chris. So go ahead and give us a little bit more information about you. So kind of tell us who you are, what you do, and how what you do provides value.
Sure. So I've been in the insurance business since 1998, dealing with life insurance, mainly estate planning, and using insurance as a financial tool. Also have worked with small businesses, setting up 401ks and overall retirement plans for people. I started with the Prudential back then doing that, and over some years had some changes. And today I work with a company called TruChoice Financial. We partner with IAD, and I focus on helping grow the life business for you guys. What I do is generally help advisors understand where and how to fit life insurance, whether it's for traditional needs, whether it's for cash growth, whether it's for tax diversification. I help them understand how to fit that into an overall plan, along with helping them how to open up the conversation and see how easy it is to get those opportunities.
Awesome. Well, yeah, we definitely appreciate your partnership with us, Chris, because honestly, every single time that you do a webinar training with us, I actually do learn quite a bit. And like I've explained to you before, I'm very much like a newbie when it comes to the life insurance and the tax diversification strategies and all this stuff. So I'm really glad to have you here because today we are going to be talking about IULs. So what they are, how they work, and how this type of life insurance differs from other options in today's world. And really to use this as a means to educate the clients of our insurance agents on IULs and how it's a superior option in comparison to common options like 401k, Roth, and IRAs, as well as bank CDs. So let's go ahead and dip into some insurance, shall we?
Sounds good.
I'm going to start off with our first question, which is, what is an IUL and what does IUL stand for and how does it work?
Sure. So an IUL is a permanent type of life insurance. Okay. So to get a little bit deeper, but stay high level, there's essentially two categories of life insurance. There's term insurance, which, stands for term. It's temporary. It's for a period of time. And then there's permanent insurance. And when you look at permanent insurance, traditionally you had whole life insurance, you had universal life insurance, okay? And underneath universal life insurance, you then have a couple of subcategories, if you will: guaranteed assumption, guaranteed UL, variable universal life, and indexed universal life. Okay, so IUL stands for indexed universal life. Sometimes you'll see it called FIUL, which stands for fixed indexed universal life.
Okay, awesome. Okay. So how did IULs, in your opinion, start gaining popularity? What sort of timeline does that look like in the past couple of years? And how have people really started to generate interest around IULs?
Well, I can tell you, I've been in this business a long time. And when I came in, IULs were not a thing. Okay.
Mm-hmm.
You were selling term insurance, you were selling whole life insurance. And for your clients that wanted something with a little more zip, I worked with variable universal life. Okay. The indexing market, I think, started on the side with annuities. I can't tell you exactly the date. I would say mid 2000s when this stuff really started catching on. But the IULs, they really started kicking up, and probably about 6 or 7 years ago did they get really big. And the reason they got big was you're able to gather or get the upside of the market, right? You're still able to get really big returns with this product, but you don't have to worry about the downside of the market. Worst case scenario, you get a zero on your account. Now, when you take that and compare that to the alternative, which used to be a variable universal life, and variable universal life is still there, and I'm not going to be speaking ill of it, but why go into a variable universal life where you get the upside of the market, but you also partake in all the downs? You could get negative returns when you could go to an IUL that's going to give you strong upsides, generally have lower internal costs, and worst case scenario, you get a zero. So they really probably about 6 or 7 years ago became a thing because that's what they did, right? And you were able to use them inside of a portfolio to mitigate risk and have an option that did something different than every other part of your portfolio.
Yeah, yeah, I think that's really great too. So for me, from I guess I don't want to say like a younger person standpoint, but because I feel
Uh-huh.
like I'm the baby of the office here at IAD, right?
Sure.
So for me, like coming into this industry and thinking about, okay, now I really need to start looking into my savings and start like, and start with a 401k. I had a 401k with my previous employer, but I wasn't really sure like what I could really do with it now that I'm here at IAD. And I'm really starting to think of, okay, what do I really need to do to start saving for retirement? How can I get the most bang for my buck? And how can I start using other forms of insurance in order to benefit myself so that then by the time that I retire, I mean, because shoot, the cost of living in general, like in the last just 3 years, has skyrocketed. So now what's it going to be in another 40, 50 years? Are our traditional seniors in the next 40, 50 years, are they going to be able to live off of the type of savings that, we were told 10 years ago that we would
Hmm.
be able to live off of? I mean, so there's lots of uncertainty. And so there's different ways that people can start saving for retirement, as well as using life insurance as a means of, for like final expense and paying for funerals and all these other things that we need to like have money
Hmm.
for, because obviously it's expensive to live, but it's also almost more expensive to die. So
Yeah.
so it can be kind of difficult to think about, what are the things that we can use to save for our retirement that are aside from the more traditional things that most common people in today's world are aware of. So, in your opinion, what are the benefits of an IUL? I know that we had already talked about that you don't get the market dips, but you're really just seeing like that growth.
Yeah. Well, to kind of piggyback on what you were saying, talking about yourself, right? Where an IUL works really good is obviously if somebody has a need for insurance, right? Then it's really clear. But you don't have to look at an IUL as essentially just that old kind of idea. You can look at this as a product that's going to bring innovative new ways to save money moving into the future. So when you take an IUL, and if you want to compare it to some other options, right, like a 401k or a 403b, something of the such at work, these are two plans that, what do they do? Right? It's tax code. It's a way for you to partake in pre-tax money and get some dollars given to you by your employer that are all taxed, not taxed, right? They're put into the account tax-free, or pre-tax, I should say. They grow tax deferred, but then when you take them out, you got to pay taxes on it. And the issue that comes in with that is the fact that right now our country's over $31 trillion in debt. By 2026, we're talking over $40 trillion in debt. The bottom line, everybody out there is saying taxes are going to go up. Okay. And when you look at this, what you need to realize is, hey, that doesn't mean that 401ks and 403bs are bad. Because Kelsey, I'm going to tell you something. I'll actually turn this back on you and ask you a question. What is the best type of money that you could get in life?
Oh gosh, free money, I guess.
There you go.
Okay,
You
okay. I was
hit
gonna
it on
say
the
like I
noggin.
knew the answer to this one.
The best type of money is free money. And
Yeah.
where do you get that? Right. Well, if you have an employer that'll match on a 401k, whether they match 1%, 5%, 7%, you should at least partake in getting that free money.
Yeah.
Okay. Make sure you put in what you have to get that free money. But now, when we get past that, there's no reason to put anything more than that in there, because all you're doing is creating a tax time bomb for yourself. So, this is where you take, and what we talk about is put that excess dollars into an IUL. So why IUL? Well, here's the deal. It's going to give you tax-free growth, right? You're going to pay taxes on the money you put in there today at a historically low tax rates that we're in, and it's going to grow tax deferred, and it's going to be tax-free when you take it out. But here's why. You might be saying, well, why not Roth IRA? Because in the Roth IRA, if you make too much money, you can't put money into the Roth IRA, right? There's limits on how much you could put into a Roth IRA. But the biggest one, if we were talking about you, Kelsey, is the idea that your Roth IRA, you have to have it for 5 years and be 59 and a half before you could take anything out, unless it's for five options: first time home buyer, qualified higher education, medical expenses, death or disability, right? So what I say is, hey, have that 401k, do what you're going to do there, but then have the IUL. Fund that as if that's your Roth IRA. Now you have not all your money sitting there that you have to wait till 59 and a half. You have the ability to use this money. You see all these people on TikTok and different social media showing all this stuff. Everything that they're talking about has always, I'm here to tell you, always been available in permanent insurance. It's just now people are starting to see the true value, and IUL has added a different twist to that. And that's why a lot of people are showing it a lot more out there on how it could work and help you become tax diversified. So I don't know if I really answered your question, but some of the benefits are tax deferral, tax free, overall mitigation in your portfolio, right? That's where and how an IUL works and what it does for you. Now,
Awesome.
I actually forgot one more thing, Kelsey. Let me say this, living benefits. Totally forgot about that. Your living benefits in there. Right off the bat, you have a pool of money. If you have an IUL that has a face amount of, let's call it 250,000, some of these policies have living benefits. If you were to get in a car accident, become paralyzed, if you were to get cancer, if you were to have a stroke, severe burns, traumatic brain injury, if you were to go into a nursing home, have a heart attack, okay? A lot of these things with today's medicine, we could come back from, right? But we might be out of work a lot. The IUL is going to give you a pool of money that you could pull from to help you stay afloat during that time when you're not working. Where if you have a Roth IRA or a 401k or something like that, all you have in there is the money you have in there. End of story. That's that. So that's another reason why the IUL works really well.
That's really cool. One of the things that you actually said that I wanted to draw a little bit more attention to was when we were talking about the IUL in comparison to the 401k, how the kind of like the taxes all work and the tax diversification of these two different options is that with your 401k, this is money that's essentially being given to you by your employer, and your employer can match what you're putting into the 401k. But when we're talking about an IUL, we're talking about a product that this person is paying into. So this is money that they have already received in their paycheck from their employer. But because it's separate from an employer-based savings account, this person is paying into this different type of a savings option, and you're essentially paying like a monthly premium on it, the same way that you would kind of like health insurance. Is that correct? Or correct me on that if I'm wrong.
Yeah. I mean, yes, you're going to pay something monthly, quarterly, semi-annual, annual, whatever you want to do, right? The beauty of it is a lot of times when the advisor sits down and talks to somebody, we're going to find out what fits in the budget, right? What works. Because these accounts, I want you to know that I work with people in all budgets. I have some people that are able to simply set aside like 10 or 15 bucks a week for it. We got other people that are setting aside $500 a week. We got people doing even more than that. And so this is the situation, is it works in all budgets. The more money you have, the more you could get, the more you could save. That's what it is. So you could systematically save in there. You don't have to have a lot of money to start it.
Yeah. Okay. Well, actually, so one of my questions for you is going to be, what are any caveats to IULs? So my question for this would be like, what would be any sort of like tax implications or penalties associated with, because you had mentioned before, like if you have cancer or if you need long-term care or if you are unable to work and you're paralyzed and you need to be able to take this money out, you've got this pool of money. Are there any sort of like negative associations with taking that money out after you've put the money into the account?
Well, so the beautiful thing, one of the big differences when you have an IUL and you want to take money out of there. Let's go back and let's just talk costs, I guess, full disclosure. Because there's the insurance aspect of it, there is a cost for that insurance, okay? That's baked in, that's in there. But you know what? There's costs behind 401ks. There's costs in all the sub accounts that you have in the different mutual funds that you might invest in, okay? One of the myths is that the IUL is going to cost a lot of money. And what I say to people is compared to what? Truthfully, tell me what this is expensive compared to, because it's really not. When you put pen to paper and you see what it is, sure, in the first 5, 6, 7 years, an IUL will cost a little bit more than some other options that are out there. But when you start looking at 10, 20, 30 years, in some instances, it's actually cheaper than having a Roth IRA or some of the other savings options that could be out there that you use. Okay, so that's one thing. Let's be clear on that. Where it makes up for some of that, though, is the fact that one, you'll never, ever, ever have a negative return, right?
Yeah.
That's one thing that's great. 2, you have the annual reset, which means if the market is down in 1 year, all the money that you've made is locked. You don't lose any of that money. But in that new year, you're going to start earning money from that down point in the market. So there's the annual reset where you're always starting from that bottom point and moving forward. So it gives you a lot more opportunity to grow your dollars. And the third thing when we're talking about pulling money out is what's really cool is when you pull money out of an IUL, even though you pulled that money out, the IUL actually still looks at it as being inside the IUL. So you still earn interest on that money that you pulled out. Where when you pull money out of a 401k, when you pull money out of an IRA, when you pull money out of a Roth IRA, a 403b, a brokerage account, when you pull it out, it's gone. You sold those shares, done. Vamonos, finished. They're out of there. Okay. So that's one of the big points of an IUL is the fact that you have the annual reset and you have the ability to still earn interest on money that you pulled out of the account.
That's really, really cool. I really like that option as well, because for me, I really wish that I had like a diagram to be able to show to everybody, especially since we're doing this as a vodcast as well, so which will be up on the YouTube channel. So I really wish that I had like a more of a visual representation of what you were saying about that your money starts growing again, even if the market is down, and then you get that annual reset. Where to me, like in my mind, that looks like, okay, so like the market is down, you're kind of just like flatlining at that point. But then once the market starts going back up, does that money start growing again from that point? So if the market is kind of just like is down and dip and your money is up here, that when the market starts growing again, that money is growing with it in synchronization with
100%.
the market. Oh, okay. Perfect. Yeah.
So your example that you just did is really good. So if you think about like, let's just talk 401k, right? If you could put your hands back up there, since I was looking at you with your hands, and we're going to say that the 401k now is down at that bottom hand, right? Yes, that's where the 401k is. But put your hand back where it was, the top hand, your IUL, that's where your money still is there. Now, in the next year, if the market starts going up, keep the IUL where it's at. Don't move the IUL. But that 401k starts going up and stop right there. So now that 401k, even though that second year, let's say that was a 10% return you got on your 401k, right? Your 401k actually just got itself back to an even point, right? It just got back to the money that it had lost. Well, your IUL is going to be 10% higher than where you have it now. There's your IUL because you never lost that money. So one of the downsides that people like to talk about is caps and participation rates and things like that, because they always think, oh, well, you're going to be capped. And that is true on some indexes, on some IULs. But I'll let you know there's a lot of IULs out there that have no cap. And there's a lot of IULs out there that'll do 100, 150, 175% participation on your money. So you're still going to get great, big, huge returns. But the bottom line is the big equalizer is the fact that the IUL will never do worse than a zero. And that helps it to, even if you only average out at 6 or 7% returns on an IUL over the long haul, that's going to help it keep pace or possibly outperform a 401k that might be doing 10, 15, 20, 30% returns, but also has 10, 15, 20, 30% losses at different times as well.
Yeah. And I think that's something that a lot of people are really interested in right now as well, because our market is kind of like in that dipped sort of situation right now, is that, there are lots of people that are maybe in their like 40s and 50s, maybe even like their early 60s right now. And they were thinking about retiring within the next like 5 to 10 years. And they're kind of freaking out because they're like, oh my goodness, I lost all this money. And, when you're younger, when you're in like your 20s or 30s, you're like, okay, well, I still have time for this money to grow, because the market is going to continue to grow and it's going to have its ebbs and flows, like, it always does. But, for somebody who's maybe a little bit older, they're not happy campers right now. So at what point and the IUL has all of these additional benefits and not really any of the caveats that a traditional 401k does. But I know we had already touched on this a little bit before, but let's go ahead and kind of talk about what exactly is a 401k, how does it work, and why is 401k commonly offered by employers as opposed to an IUL?
Yeah. So, 401ks, right? What are they? What exactly do they do? And what they are is they're a qualified sort of profit sharing plan. That's not the right way to say it, but they're a qualified plan where an employee can defer salary. All right. They could defer a certain amount of their salary each and every year. And the employers then are able to match a certain percentage of that salary that they choose to match. Okay. And so these became real big. These plans became real big when pension plans kind of went out like the dinosaur, because the pension plans were so expensive and hard to keep up. Quite frankly, pensions are just absolutely marvelous, right? They're great, but they're so great, they're expensive, they're hard for employers to keep going, the whole thing. So they went into more of where the employee has to be more, active in their own savings. And so the benefit to the employer is if an employee puts money pre-tax, right, or before tax into a 401k, that employee now is showing less salary. Okay. So with them showing less salary, the employer now saves on payroll taxes and on social security contributions and things like that. So it benefits the employer on that side, and the employee, it benefits because they're able to take a dollar for dollar, save it in this plan, save on taxes, right? Lower their tax bracket possibly, and also get a match. Now, here's the thing. These things were awesome when people used to retire, and they would retire and be in a lower tax bracket, right? Because the theory would be, hey, you're going to be in a lower tax bracket when you retire because you're going to be making less money. Well, here's what's gone on is we went through the longest bull market in history. We've had historically great market returns for, the last 20, 30 years. People have exploded their retirement accounts. And what's going on now is our national debt has continued to go up at the same time. And now we have this perfect storm of people still being able to retire with very close to the same amount of income that they had while they were working. And now we're looking at the possibility of tax rates going up. So people are going to be retiring with a higher tax bracket possibly. So what started out as something really, really good and still is good. I'm not saying it's not. I'm just saying that the idea of being in a lower tax bracket when you retire, thus paying a lower tax rate on the money that you put in pre-tax, it's not exactly true anymore. And that's why what somebody like myself and a lot of the advisors I work with, that's why IAD, we help advisors to understand tax diversification is a big part of somebody's retirement planning, because taxes are going to be, if not the biggest, the second biggest obstacle that you're going to have to deal with in retirement.
Yeah, I agree. That's something that, again, I feel like I'm going to have to repeat myself in this sense quite a few times over the course of doing these podcast sessions with all of these financial advisors in regards to how taxes and tax diversification works. Because again, I that's something that I'm not educated on, and I know that that's something that not a lot of my peers or anybody else is really educated on, because we kind of just leave that type of stuff to our industry experts, and that's not something that a lot of people are really educated on. And I feel like that if they were, they would be a little bit more up to being more careful with what type of options for savings that they're putting their money into. And especially since we're looking so closely at how the market performs, but we're not being too careful in the sense of how that is going to impact us in retirement. And even when I was, oh gosh, this was probably almost 10 years ago or so now, I was taking a political science class in community college where we talked about the national debt clock.
Mm-hmm.
And you can even go to, I think it's nationaldebtclock.org or something like that, the website is, and you can see the national debt clock going up in real time. And at that time, I want to say the national debt was, if it's 23 trillion now, I want to say at that time it was maybe 17 trillion, something like that. And we were sitting there thinking, we had a kind of a class discussion about it, and we were like, how long would it take us to pay off the national debt? Or even if the national debt stopped right there, how long would it take us to pay it off? Like, we would literally go until the end of millennia. It would be the next 200-300 years. But now we're also sitting here like questioning, like, okay, is the world even going to still be here in the next 200-300 years because of all the environmental issues that we're experiencing? And there are people that say that there are no such thing as environmental issues, and so I'm gonna let you believe what you want to believe. But on the flip side of the same coin, like, we still are dealing with all of these issues, the very real issues in today's world, and we're trying to provide solutions in how to combat the caveats of today's savings. And because people are living longer, they're staying in retirement longer, we're experiencing market issues with the stock market, but we're also dealing with potential crashes again in the housing market. Like, and people are we're dealing with essentially like an affordable housing crisis. We have, I want to say that I was watching CNN, and this was like a couple weeks ago, where 42% of the US recorded births, I don't know if this was specifically for like one hospital or if it was like nationally, but 42% of births last year were Medicaid births. So there are lots of people that are sitting here living essentially under the poverty line. And we're trying to get these people to invest for their future, but they're still kind of essentially living paycheck to paycheck in a sense. So we're trying to caveat all of these additional, like you said, it was like the perfect storm. So we're kind of just having to batten down the hatches at this point and really start putting our money in safe places so that we can continue to live normal lives, or whatever normal is going to look like in the next 5 to 10 years.
It's a tough situation out there, Kelsey. It really is with the national debt. Actually, to tell you, you were talking about the debt clock. It's actually the usdebtclock.org is what you
Okay.
do for anybody who
Yes.
wants to see that. I use that quite a bit. But, pre-COVID, I think the national debt was 22, 23 trillion right at that time. Then during COVID, all the money that we infused into the economy and everything that went on there, right, wrong, or indifferent, doesn't really matter, right? People like to complain and argue about this stuff. It doesn't matter. It is what it is. We did it. We thought that's what we had to do. Right. And that's that. So we sit where we are today. And the truth of the matter is the big thing out there is, hey, we need to spend less money. Right. That's what people say, like, oh, the government, if you don't have the money, don't spend it. Hey, we need to stop spending on this program or that program. And here's the situation. You could stop spending on almost all these programs, right? But the interest on the debt that we have alone, it's virtually impossible to pay that back without bringing in more revenue to the government, right? So, and this is what it is. You don't see politicians saying, hey, we need to curb spending. But to them, that doesn't mean stopping their pay raises. That doesn't mean stopping their free health insurance that they have that's top of the line, right? It doesn't mean that they want to stop spending in each of their districts on what they need where that is. They want everybody else to stop spending. And so the point that I'm making is this is really the question that we all got to ask ourselves on this podcast. You and me and anybody who's listening, the question is, do we think it's possible, right?
Yeah.
Do we think it's possible that taxes will go up? What's more realistic? Right? Is it more realistic that they're going to quit spending, or is it more realistic that taxes will go up? It doesn't need to be, when it comes to the financial side, it doesn't need to be a political swing. It just is what it is, right? We all have our own take on what that is. And even though that's a big part of what's going on, the bottom line today, the two biggest problems that people have with getting to and through retirement is saving enough money and taxes.
Yeah.
Okay. We could pull in there living longer lives. We could, health, all these sort of things in retirement, inflation, investment risk, sequence of returns risk. All this stuff is there. But the bottom line it comes down to is, have you saved enough money, and are you going to be able to keep enough of that money?
Yeah.
And that's why you and me are talking today, right? 401ks are great. Go get that free money. Roth IRAs are great until they're not, meaning you want to get money out before you're 59 and a half, or you make too much money so you can't have one, right? Roth IRAs are great until, you sit there and say, holy smokes, 99% of all Roth IRAs are invested in mutual funds and ETFs. Nothing wrong with that. Nothing wrong with that at all, except for 401ks are all invested in those things too. So why not take and have something outside of your 401k that's going to react different to the market? And that would be your IUL with index options inside there.
Actually, I'm glad that you brought up IRA and Roth, because that was actually going to be my next question is, so what is the difference between IRA and Roth in regards to a 401k account?
Well, okay. So a traditional IRA is all tax deferred money that'll be taxed in the future. A Roth IRA is taxed money that's already been taxed that is going to grow tax deferred and be tax free in the future. Okay. So a 401k, a traditional 401k is exactly the same as an IRA. It's all pre-tax dollars that grow tax deferred, and you're going to get taxed on it in the future. There are Roth options inside a 401k now as well. Again, not saying anything bad about it. You just got to remember, when you put money in a 401k, what accessibility do you have, right? When can you get the money? Are there any penalties? Do you have to be 59 and a half? Can you take a loan out? If you have a 401k and you take a loan out and you leave your job, you're not able to get that 401k till you pay the loan back. There's a lot of different things that happen. And that's why I don't only talk about diversification within the market, but diversification of your portfolio as a whole, to where we're diversifying to have accounts outside of the market and outside of that work employer deal, and make sure they're tax diversified as well.
Yeah. I think that that is something that a lot of people just really need to know about, because I think that there are lots of people that say like, oh, I've heard that Roth IRA is better than a traditional IRA, but they don't really know exactly how the tax diversification works. And that there are so many people that, especially so in the state of Michigan specifically, the average income is about anywhere between like 63 to about $66,000 a year. And that's just the average. But there are quite a few people that are making, anywhere in that $30,000 to $40,000 year range, which is really just enough to kind of get them by. So they're thinking that, okay, this Roth IRA that is offered by my employer, this is money that I don't really have to see. It's kind of like out of sight, out of mind type thing. So if it's money that is taken out of your paycheck after you've been taxed on it, once the rest of that money hits your checking account, you're like, okay, well, this is what I have to spend for the rest of the month, or however many weeks until I get paid again next. So that can be kind of like the benefit for somebody who is looking to save money for retirement, but is maybe just not as financially responsible. And that's something that we're having to deal with a lot of as well, because especially in today's world, especially with social media, there are so many like influencers and brands and things that are saying like, oh, you need this, you need that, you need this, you need that. Like, oh my goodness, like shiny, like buy this, buy that. And there are people that have Amazon storefronts that are like, oh, well, here, you can buy this stuff from my Amazon storefront. We can get anything off of Amazon these days, right? So, but how much of this stuff or these products do we actually need? I mean, I would say that it's a very, very, very small percentage of things that we're purchasing on Amazon just because some sort of influencer or brand representative told us that we needed it. And so social media has kind of just become this like powerhouse of pushing products and services over the last however many years. But it's also kind of like a detriment to our savings. So when I think about if I were somebody who was not financially responsible and didn't pay myself first, in the sense of that I wasn't making sure that all of my bills were paid first before I went out and spent any sort of money for my paycheck, it might be hard for someone to try to put that money towards an IUL, because that's already money that they haven't had taken out of their paycheck yet. So, but in your opinion, what would be a way for someone, especially maybe someone who might not be as financially responsible, to start putting that money towards their savings? And how can agents present life insurance or an IUL as a means of growing someone's wealth and providing general wealth for their family, especially if they're not financially responsible?
Well, okay. That's a very, very in-depth question. That's actually very here's the thing. Everything that we're talking about today is general, right? We got to
Yeah.
make sure as advisors, whether you're insurance only, whether you're a 65 licensed person, or whether you're a registered rep, right? What my big thing is in my career today is I coach advisors, right? I help them to understand how to build full plans to include investment options, annuities, life insurance, and all this stuff put together, and to make it have a holistic way of working together to help the client achieve their goal and to help them get through retirement. And so, to get to your question, if an advisor is talking to somebody, it can't be a one size fits all, right? You need to make sure that you're doing the right thing for your client, for your prospect. You need to make sure that when you know that you're going to take their situation, look at it, assess it, and do what's right for them, you are going to get more clients than trying to force feed something down the proverbial throat. Okay. So to your point, somebody who maybe isn't making a ton of money, right? Let's take the scenario to be this. They're 26 years old. They're just out of college a few years prior. They've been into their job, 2-3 years. They've gotten married now. This person and their wife live in their first apartment that they have. He's making $45,000 a year, right? They just had a baby and she's at home raising this baby right now, but they're both educated, plan on making more money in the future. How do you help them? Well, the way you help them is you let them know that this is a situation that term insurance is needed. It's not the IUL, but it's term insurance. It makes sure that his dreams come true no matter what. It makes sure, God forbid, something happens to him, his wife and child are taken care of the way that he wants them to be taken care of. Okay. Now, you also need to tell this person your 401k at work is imperative. Your employer is going to go ahead and match you 3%. 3%. If you're making $40,000 a year, what is 3% of that? What is it? Well, I'm going to do the math here because I don't want to sound stupid, but it's $1,200. So let's say you have to put in $1,200 to get that 3% match. So how many pay periods do we have? Let's just make this very easy. Let's just say somebody's got 24 pay periods, okay? 2 a month. Let's just leave it at that. That's basically $50 each check. Okay. So if you tell your client, listen, you need to start having $50 a paycheck come out and go to your 401k. They're not going to notice that their paycheck goes down $50 because it comes out pre-tax. So their paycheck might only go down $40 or something. But you're now doing a good job as an advisor helping them to move forward, but you're building the footwork for yourself as an advisor to grow with this client. You got them term insurance. You could now help them as they start making more money. You could help them convert that term insurance to a permanent IUL that now they could start growing cash there as well. Does that answer your question? I guess what I wanted to try to get across for everybody listening is IULs are great. I really, really believe that they are one of the most innovative and best things since sliced bread with everything that they can do. But we need to know who's our client, who are they, and where are they? And you need to understand how to help them while helping build your business to move forward. And the way you build your business is by growing your client base. And you grow your client base by helping them with what they need. And what they need is an IUL at some point during their life. But right now, what they really, really need is to get some money easily saved, like you said, Kelsey, have it come out before they get their paycheck, and then have them buy some term insurance that's going to cost them like $15 a month. Okay. That's my idea that I would have there. Does that answer your question? Am I getting to what you want?
Yes. That actually works out perfectly, because I think that is something that a lot of young people don't really think about, because we think to ourselves like, oh, well, like, I'm not going to die until I'm like, however, whatever age, but tomorrow is never promised. I mean, I tell people all the time, I think I've disclosed this before on the podcast, that I lost my father at a young age. Well, he was rather young. He was only 53. So I'm a huge proponent of telling people, like, you need life insurance. I don't care if it is just like a final expense and if it's just enough to like pay for your funeral, because funerals are really expensive these days. My mother is a funeral admin, and the average funeral is about $15,000, and that can be pretty financially crippling to a lot of families in today's world, because not everybody has $15,000 just laying around, especially if you're only making $45,000 a year. So especially if you're a new father to a wife and a child, because in this country, we obviously treat women like garbage after they've had children. Like, everybody loves a good pregnant woman, but as soon as that baby comes into the world, it's like, oh, well, we don't really care very much about the mother and her needs. There are all these checkups for babies, but there are, there's like one postnatal checkup for the mother. So, and then on top of that, not a lot of companies offer paid maternity leave, or shoot, even paid paternity leave. So at which point are we really focusing on the benefits of today's society? There's really not a whole lot of it. I think we're getting like really hot and heavy in the topics of this podcast. I wasn't really expecting it to go this way, but I think it's really real information that people need to think about and that we need to really be discussing, because we can't just sit here with our fingers in our ears forever going la 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 la, like I don't hear it. Like, we have to acknowledge the fact that these issues exist, and we have to come up with solutions in order for it to get better.
Yeah. So, the thing is, you said we're getting hot and heavy, right? It's something that happens because the product we're talking about is life insurance, right? And life insurance is something that traditionally is tied very close to our hearts. Today, what we're trying to talk about is we're trying to separate that and let people understand that it is, if not the most powerful, it is one of like the most powerful financial tools out there to accumulate wealth, protect wealth, and tax diversify yourself and your family right now. And that's the IUL. And that's what people need to know. But we just need to understand how to fit that and how to work that with our clients. So there you go.
Absolutely. Yeah. One of my last questions that I have here for you is that this is going to kind of like not make sense in our order of operations here, but I just felt like we were going so the conversation was so fluid between the 401ks and then into like the life insurance as a means for people in growing their wealth or generational wealth. But so my question is, what is a bank CD? How does it work? Why is it considered outdated? And what are the benefits and caveats?
A bank CD, I don't think they'll ever really be, I'm going to butt heads with you here. I don't think they're going to be outdated. Okay, they're
Okay.
always going to be there. They're always going to be there. They're always going to be a staple, especially for certain people, right? They're a good spot to save money for people that, let's see, don't want to take risk. Traditionally, what a CD did is it was a place that you could put money and you could take the interest and it could help you live off of that interest in retirement. That was the idea. It was a safe, simple place to put money. Your principal would always be there. When you talk about outdated, the reason you say that is because today, well, recently CD rates have been going up, but for the longest time, CD rates have been in that like 0 to 3 range where people really couldn't earn much of anything, especially after taxes and inflation, for it to actually help them. The bottom line is a CD, it stands for certificate of deposit. It's something that a bank issues and gives you a rate, and you got to keep it there for a certain period of time. The longer period of time that you keep it there, the better the rate is they give you. Generally, the more money you put in, the better rate it is they give you. I've seen these things where they're generally like 6 month to 5 year CDs. I'm not going to say they're bad. You know, if somebody wants to keep something in a bank and just kind of have it there and something where it's kind of out of sight, out of mind, but they know that it's a chunk of money that's going to come due every 6 months or every year, fine, go for it. But that's really what they do. I don't know
Yeah.
if I'm answering your question or not, but you know, that's what they are. CD is just simple product over at the bank.
Yeah, I think that that would be something that would be really helpful for someone. Like, for example, the way that I have my checking account set up is that any amount of money that hits my checking account that is over $100, 30% of that immediately gets thrown into my savings account. So kind of like we were talking about that out of sight, out of mind, sort of like
Hmm.
benefit to the Roth IRA or through your 401k is that all of that money is kind of taken out of your check before it even hits your checking account. Whereas with this, it's like the money hits your checking account, but then it immediately gets thrown into my savings, which is really great because then I don't have to think about having to transfer money back and forth. So a CD, in my opinion, might be a good option for maybe somebody who maybe already has a 401k, maybe already has an IUL or term life insurance, and is really just looking for like that short term savings option to a point where they can kind of just like put the money away, like, maybe get like a smaller return on it, but then maybe be able to take that money out in about 5 years or so and then use it to buy a car or like, those types of purchases that nobody really wants to make. Like, yeah, as exciting as it is to buy a new car, every now and again, it's kind of like, okay, well, I'm really about to shell out $10,000 to put a down payment on this vehicle. Or even, for your child's braces, braces are not cheap. I had a consultation with my orthodontist to go get Invisalign to fix up, my teeth since they've shifted since high school when I had braces. It was gonna be $6,000. And I was like, I don't exactly have $6,000 right now. I was told that this was cheaper than traditional braces. And they were like, yeah, traditional braces right now are about 10 grand. I'm like, 10 grand? It was only like four back in like 2008. Like, oh my gosh, am I really that old? Like, oh
Well,
my goodness.
you know what? With what you're saying is, yeah, I mean, the CDs fit the bill for things like that, right? But you know what? Your IUL can do that too.
Exactly. And that's
But
the
but
reason why I think that IUL would be a superior option for savings in comparison to the CD.
yes. And today, right now, as we sit, many companies out there have fixed buckets in their IUL that are paying 5%. So a lot of great options out there for that. You know, the IUL, if the whole thing, if we want to talk about one little pullback, and I hate to do that when we're trying to talk about how great they are, but it does take some time to generate some money in there, right? If you want to put money in and you want to take it back out within a year, that's not the thing for you, right? But if you're looking at 3, 4, 5 years down, well, really, I should say, if you're looking at 4, 5, 6, 7 years down the line, it's a great spot that could be a quasi short-term place for you. Now, if you start an IUL and you're putting big chunks of money in there, $10,000 a year or whatever, it's all equal, right? So you'll start having some money in there a lot sooner. But the IUL does exactly what you were saying.
Yeah. Okay, well, Chris, thank you so much for joining me today on this episode of the Direct Insurance Podcast, otherwise known as DIP. So let's go ahead and really quickly go over some of our key takeaways that we talked about from today. So we
Mhm.
talked about an IUL, which stands for Indexed Universal Life, which is a life insurance product as opposed to a more traditional savings option, although it does work like a savings option. We kind of talked about like sort of like infinite banking, where you can take money out, but then you'll still get the interest on the money that you had taken out, even though the money is technically not in that account, which is absolutely wonderful because then that savings can continue to grow. We also talked about 401ks and how they are really nice, and it's essentially like a great free money option, especially if you have access to one through your employer, because if your employer is going to match you dollar for dollar up to a certain percentage, you should definitely take advantage of that. But you should also be taking advantage of an IUL as well. We also talked about bank CDs and how this is not really necessarily outdated like I thought it was, but it can be that more like short-term savings option that'll grow at a smaller rate of return. But on the flip side of the same coin, you can do the same thing with your IUL and you will gain much more money from that. Another benefit to an IUL is the fact that if the market dips, you don't lose any money. But when the market starts to grow again, you'll start growing at the same rate of return that the market is increasing. Whereas with your 401k, the caveat to that is that if the market dips, your 401k is going to dip with it. And then if the market starts growing again, it's going to grow with the market. So the biggest benefit to an IUL versus the 401k is that so you won't lose the money with the fixed account, but you'll then grow the money once the market starts to grow again. So thank you again so much, Chris, for being such an awesome guest and talking with me about IULs versus 401k, Roth IRAs, and bank CDs, and how they really differ from one another in comparison to traditional savings options, and kind of like how we went over the benefits and caveats of each. Thank you so much for sharing your expertise with us. And yeah.
Well, I was really happy to be here, glad to be here, and hope to do it again.
Yeah. I was actually, while we were talking, I had a couple ideas for a couple other like podcast topics that I think that you'd be really particularly interested in. So I think we'll talk about that a little bit later. So Chris, before we sign off, I do have one last question for you. My question is, what sort of advice do you have for an insurance agent that is looking to grow their business with using life insurance and IULs?
Well, one, be genuine, okay? Be a genuine, real person. Two, make sure that you look at each and every client as more than just what you went there to talk to them about. If we're going to talk about Medicare, we're going to talk about health insurance, we're going to talk about an annuity. That's one thing that got you there to talk to your client, but make sure that each and every client, you have a process, okay? And if you want to know more about this process, feel free to get a hold of Bernard or myself. We could help you out, but you really should look at a 3-appointment process, and you should make sure that one part of that is that you're asking them your client questions. Okay. And one of those questions is, can I give you a review of your current life insurance program? That's all you got to do. And when you ask them that, what's their answer going to be? The answer is going to be, well, yeah, I got life insurance. The person that I work with generally does that for me. Okay, great, right? Think about this. Those of you listening to me here today, if somebody already has life insurance, you don't need to sell them life insurance. They already understand the value of it. What you need to do is find out, is their current advisor helping them? Is their current advisor doing a good job? Did their current advisor do a good job with the plan that they have? Has that plan grown with their life, right? The bottom line is if they already have it and they say they have an advisor, say that's fine. Let me give you a second opinion. Okay. The other thing that they might say is, I don't have any life insurance. Well, ding, 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 they need that, right? So now you could talk to them about it. And the last thing they'll say is, I don't need that, or I don't want that, in which case you can make a decision if that's a hill that you want to, no pun intended, but if that's a hill you want to die on, right? So, but the point is, just ask. And the last thing you need to do is make sure that they understand that you're a tax diversification specialist, and that they don't tax diversify, they're not going to be able to retire.
All really, really great points. So I was going to say, like, I'm just kind of sitting here like entranced by like everything that you had to say, because I was like, ooh, yes, like, yes, because I feel like I'm learning so much from all of this as well. And I hope that all of you guys out there listening learned something today as well. I hope that you guys learned something you can put into direct use in your business. And if you are a licensed agent in the life, health, or annuities markets and looking for an industry partner, we here at Insurance Advisors Direct would love to be considered. You can call us toll free at 1-800-381-0977 or visit our website, www.iadbrokerage.com. Make sure to check out this episode on the IAD YouTube channel on Wednesdays, the day after the podcast airs on the audio platforms. And don't forget to subscribe to the IAD YouTube channel and follow us on Facebook, LinkedIn, and TikTok. Chris, thank you so much again for joining me. And thank you so much to all of you guys out there listening.
Thank you very much. I had a great time.
Thanks. I did too, Chris. Thank you so much.
Bye-bye.
Bye.